Welcome to today's market report. European stock markets set for negative start. US-China tensions rise. US tech giants fail. Yesterday there was a sense of optimism running through the markets as the FDA fast-tracked a couple of drugs that have the potential to be COVID-19 vaccines. Pfizer and BioNTech are working on 4 drugs that they are hoping to go on to be coronavirus vaccines, and FDA put 2 of the 4 on a fast track for approval. At the back end of last week, BioNTech said they could receive approval as early as Christmas, but in light of yesterday's news, it might even be sooner. European equities closed higher and US stocks got off to a good start on the back of the news. China reported positive customs data, an encouraging sign that the world's second largest economy is recovering from the damage caused by the COVID-19 virus. Chinese exports and imports benefited from some countries loosening lockdown measures and the resultant uptick in economic activity. The British economy also grew 1.8% in May, only a slight rebound after the deep fall caused by the shutdown from the coronavirus pandemic. Analysts had predicted an expansion of 5.5%. UK industrial production was still down 20% year-on-year in May, and manufacturing output down 22.8% on the year. Elsewhere, the COVID-19 virus continued to wreak havoc as the total number of cases climbed over 13 million cases globally, according to data from Johns Hopkins University, surging by 1 million in 5 days. In the US, the most populous state, California, reshuttered bars and orders restaurants and movie theaters to cease indoor operations. The move is the clearest signal yet that the US will have to reimpose economically damaging measures to bring the spread of the virus back under control. Adding to the cocktail of concerns, tensions between the US and China continue to simmer, with the 2 sides wagging a war of words over China's claims in the South China Sea. In corporate news, Swatch Group said on Tuesday that it swung to a loss during the first half of the year due to the closure of most of its stores during the coronavirus pandemic. UK online food retailer Ocado, meanwhile, reported 27% growth in revenue and a narrower pretax loss in its first half report. Eyes will turn later in the session to the start of the US earnings session, with big banks beginning to report second quarter results. The expectations are that they will show weakness along with the broader market because of COVID-19 shutdowns, which dominated much of the quarter. Oil price weakened sharply on Tuesday amid worries for the recovery of crude demand as California, the most populous U.S. state, ordered a new lockdown on businesses to combat the resurgence of COVID-19 virus. This comes ahead of a meeting of OPEC's technical staff on Tuesday and Wednesday, who are expected to recommend the group and its allies, including Russia, stick with the current plan to taper its record supply cut of 9.7 million barrels per day to 7.7 million barrels per day from August through December. US crude futures traded 2% lower at $39.29 a barrel, whilst the Brent contract fell 1.4% to $42.14 a barrel. Gold futures fell 0.7% to $1,801.75 per ounce. The GDP news in the UK seemed to doing little to support the sterling pound. The cable has retreated from the 126.50 level. According to FX strategists at Commerzbank, a no-deal Brexit agreement is going to weigh on sterling, and the GBP-USD pair should fall to 125 level. Euro-dollar is posting small gains on Tuesday as the pair heads towards the 113.74 July high and the June peak at 114.22. The single currency is consolidating its role as the most overbought currency in the G10, whilst the dollar index was up 0.2% at 96.547. Dollar yen was up 0.1% at 107.31. This is today's market news. Thanks for listening. We'll see you next time.